Have you ever wondered why economic crises occur and what their implications are? From the fall of ancient civilizations to the tumultuous markets of today, economic crises have been a constant companion of organized economies. They've shaped nations, toppled governments, and disrupted lives. Their impact reverberates through time, leaving a trail of lessons in their wake. So why do these crises happen, and what are their far-reaching consequences? Let's embark on a journey through time to understand the origins and consequences of these economic upheavals. The roots of economic crises can be traced back to ancient times. A journey into history guides us to the Roman financial crisis of AD 33, one of the earliest known financial upheavals. Rome, the epicenter of civilization, was not immune to economic turbulence. The crisis was triggered by the Emperor Tiberius, who clamped down on money lending. The sudden withdrawal of loans led to a severe liquidity crunch, collapsing the Roman economy. The consequences? Bankruptcies, property foreclosures, and widespread public distress. As we move forward in time, we land in the 14th century in medieval England. Here, the rhythm of economic life was dictated by the agricultural cycle, and the economy was largely based on feudal relationships. However, a series of unfortunate events led to a severe financial crisis. The Great Famine of the early 1310s, followed by the Black Death in the 1340s, decimated the population. This resulted in labor shortages, skyrocketing wages, and inflation. The consequence? A social upheaval that shook the very foundations of the feudal order. These historical crises, though separated by time and geography, share common threads. Both were triggered by sudden and unexpected events. In Rome, it was a policy change, and in medieval England, it was a natural disaster. Both led to severe economic contractions and social unrest. And in both instances, the recovery was slow and painful. So why revisit these ancient crises? Because history, as they say, tends to repeat itself. The economic crises of the past serve as a mirror to our present, reflecting the cyclical nature of economies. They underscore the importance of resilience and preparedness in the face of uncertainty. They remind us that economic systems, like all human endeavors, are vulnerable to shocks and disruptions. Though they took place centuries ago, these crises share striking similarities with modern economic downturns. Just as the Romans and the English had to navigate their way out of economic turmoil, so do we. The lessons from the past, if heeded, can guide us in confronting the economic challenges of the future. Fast forward to the 20th century, the Great Depression paints a stark picture of economic turmoil. The world, brimming with optimism and the promise of technological advancement, was soon plunged into an economic abyss, the likes of which had never been seen before. Let's talk about the causes. The Great Depression was triggered by the stock market crash of October 1929. Wall Street was gripped by panic, and millions of investors were wiped out. But the stock market crash was just the tip of the iceberg. Underneath lay a fragile economic system burdened by a decade of reckless speculation, lack of diversification, and an unhealthy banking structure. Then came the ripple effects. The collapse of the American economy had a domino effect, sending shockwaves across the globe. Countries dependent on American financial support found themselves in dire straits. Unemployment soared, businesses shuttered, and breadlines stretched for miles. The world was caught in the throes of an economic crisis unparalleled in modern history. But it wasn't just about the economic downturn. The Great Depression also reshaped the socio-political landscape of the world. Discontent and despair gave rise to radical political movements, further destabilizing an already volatile world order. The aftermath of the Great Depression witnessed a profound shift in economic thinking and policies. Governments around the world took a more active role in managing their economies. The United States, for instance, introduced the New Deal, a series of programs and reforms aimed at providing relief, recovery, and reform. This marked a significant departure from the laissez-faire economic policies that had been the norm. The central banks also learned a crucial lesson: the importance of acting as a lender of last resort during economic crises. The Federal Reserve's failure to provide adequate liquidity during the early years of the Depression was widely criticized, leading to reforms that would shape central banking for decades to come. The lessons from the Great Depression still echo in the corridors of economic policymaking. It stands as a stark reminder of the havoc that economic crises can wreak, and the necessity of vigilant and proactive economic management. It's a chapter in our history that continues to inform and guide us as we navigate the turbulent waters of the global economy. Let's turn the pages of history to the not-so-distant past, the 2008 global financial crisis. In the early years of the 21st century, the world economy was riding high on a wave of prosperity. But beneath the surface, a perfect storm was brewing. Central to this were risky banking practices, a housing bubble, and the catastrophic collapse of Lehman Brothers, an investment banking Goliath. The banking industry, once viewed as a bastion of stability, had become a house of cards, built on a shaky foundation of subprime mortgages and risky financial products. Banks were handing out loans to people who, under normal circumstances, might not qualify, fueling an unsustainable housing bubble. When the bubble burst, it took down with it not just the American economy, but the global economy too. The fall of Lehman Brothers in September 2008 marked a turning point in the crisis. Their bankruptcy, the largest in U.S. history, sent shockwaves around the world. It was a stark reminder that the fortunes of the world's economies were deeply intertwined. Suddenly, the world was plunged into a financial crisis of a magnitude not seen since the Great Depression. The repercussions of the 2008 crisis were felt worldwide. Millions lost their jobs, their homes, and their savings. Countries teetered on the brink of bankruptcy, and global markets went into a tailspin. In the aftermath, governments and financial institutions were forced to take a hard look at their practices. New regulations were put in place to prevent such a catastrophe from happening again. The Dodd-Frank Wall Street Reform and Consumer Protection Act in the U.S., for instance, aimed at increasing transparency and accountability in the financial sector. Yet the scars of the crisis remain visible even today. It's a stark reminder of the damage that can be caused when greed and irresponsibility go unchecked. It underscores the importance of robust financial regulation and oversight. The 2008 crisis serves as a reminder of the interconnectedness of today's global economies. So, what can we learn from these economic crises? Well, for starters, they're not as random as they might seem. All economic crises, from the Great Depression to the 2008 global financial crisis, have their roots in a sequence of decisions, actions, and conditions that, in retrospect, we can see were a recipe for disaster. Over-speculation, over-leveraging, lack of regulation, poor economic policies, and systemic imbalances have been consistent players in the game of economic downfall. And what about the consequences? They're far-reaching and long-lasting. Economic crises don't just result in lost wealth and increased unemployment. They lead to political instability, social unrest, and a widening gap between the rich and the poor. They erode trust in institutions and systems, and they can take decades to recover from. But understanding the causes and consequences of economic crises isn't just about looking back. It's about looking forward. By understanding the conditions that lead to economic instability, we can put in place measures to prevent it. Sound economic policies, robust regulations, and vigilant oversight can go a long way in maintaining economic stability. For instance, central banks around the world now have a greater understanding of the role they play in managing economic cycles. They have tools at their disposal to keep inflation in check, to avoid asset bubbles, and to ensure that the financial system remains robust. Regulators too have learned from past mistakes. They're now more focused on monitoring systemic risk, ensuring transparency, and enforcing rules that prevent reckless behavior by financial institutions. Finally, we, as individuals, also have a part to play. By being informed, by understanding the economic forces that shape our world, we can make better decisions, whether it's about our personal finances, our businesses, or the leaders we choose to guide our economies. While we cannot predict the future, understanding our past can help us navigate the economic challenges that lie ahead. In conclusion, economic crises are complex events with far-reaching impacts. These are not mere statistical blips on an economist's chart. They are powerful forces that can reshape nations, redefine politics, and drastically alter the course of individual lives. As we've journeyed through the annals of past crises, we've seen the devastating effects of the Great Depression and the global financial crisis of 2008. Yet, each crisis also presents an opportunity to learn, to adapt, and to innovate. The study of these economic upheavals, their causes, their development, and their aftermath is not just a pursuit for economists, but for everyone. It is through understanding these events that we can better appreciate the intricate workings of our global economy. It is through this knowledge that we can grasp the interplay between policies, markets, and human behavior. And so we encourage you to continue delving into the fascinating world of economics. Be it through reading, enrolling in courses, or engaging in thoughtful discussions, every bit of learning helps us make sense of the world around us. In a world that's constantly changing, the understanding of economic crises is not just an intellectual exercise, it is a necessary tool for navigating the uncertainties of the future. As we continue to grapple with economic uncertainties, remember that knowledge is our best defense. Until next time, stay curious and keep learning.